Before we dissect what just destroyed billions in wealth, I need you to understand something. The information you're about to receive isn't available on the evening news. It's not trending on social media. The mainstream financial press is calling this a normal correction, a healthy pullback after an extended rally. They're lying. Not because they're dishonest, but because they don't understand the machinery beneath the surface. What you're about to learn is how money actually moves, how markets actually function, and most importantly, how your wealth can disappear in minutes while you're completely powerless to stop it. So if you value understanding the real game instead of the narrative they feed retail investors, subscribe to this channel right now and drop a comment below. Tell me where you're watching from: New York, London, Mumbai, Singapore? Because what happened Friday in precious metals markets affects every person holding dollars, every person with savings, every person who believes silver was a safe haven. Now let's examine what they did to your money. Silver's journey to $120 didn't happen by accident. For 18 months, from mid-2024 through January 2026, a perfect storm of conditions pushed the white metal into a vertical ascent. Industrial demand from solar panels, electric vehicles, and electronics consumed physical supply faster than mines could produce. Investment demand from retail buyers, institutions, and sovereign wealth funds piled in, treating silver as the poor man's gold, a cheaper alternative to $5,000 per ounce bullion. Speculators using leverage in futures markets amplified every upward move. The metal that traded at $31 in January 2025 hit $121 just 12 months later, a 264% gain, the fastest appreciation in silver's modern history, faster than the Hunt brothers' run in 1980, faster than the 2011 spike, faster than any rally on record. And just like every parabolic move in history, it attracted the wrong crowd at the wrong time. Throughout December and early January, silver's rise accelerated. Each week brought new highs. $100 fell, $110 broken, $120 shattered. Financial media called it the next big thing. YouTube channels promised $375 silver by year-end. Retail investors, the ones who missed Bitcoin, who missed Tesla, who missed Nvidia, saw silver as their redemption. They bought. They bought physical coins from dealers. They bought SLV, the largest silver exchange-traded fund. They bought futures contracts with leverage, controlling 50,000 ounces with $5,000 of margin. The leverage was intoxicating. A 5% move in silver prices meant a 50% return on capital. But leverage is a double-edged blade. And Friday morning, that blade turned. At 9:30 Eastern, markets opened. Silver traded at $114. Gold sat near $5,300. The dollar index, which measures the greenback against a basket of foreign currencies, hovered in neutral territory. Then at 10:15, Bloomberg terminals flashed a headline: President Donald Trump preparing to nominate Kevin Warsh as next Federal Reserve Chairman. In isolation, this might seem like routine political news. But markets don't operate in isolation. They operate on implications, on second-order effects, on what a single decision means for the entire architecture of monetary policy. And Kevin Warsh means one thing: tight money. Warsh, a former Federal Reserve governor, carries a reputation. He's a hawk. He prioritizes price stability over employment growth. He views inflation as a cancer that requires aggressive treatment. His appointment signals that the era of easy money, of rate cuts, of dovish accommodation is ending. Markets had been pricing in a different scenario. They expected Powell's successor to continue the pivot toward lower rates. They expected the Federal Reserve to support asset prices, to flood the system with liquidity, to make borrowing cheap. That expectation underpinned the entire precious metals rally. Gold and silver rise when real interest rates fall. When you can borrow dollars at 2% while inflation runs at 3%, holding non-yielding assets like bullion makes sense. You're preserving purchasing power, but when real rates rise, when you can earn 4% on treasury bills while inflation sits at 2%, gold and silver become dead weight. They generate no income, no dividends, no interest. They just sit there, and suddenly they're not attractive anymore. The Warsh headline hit the market like a freight train. Within minutes, silver began to slide. 114 became 112, then 108, then 102. The selling was orderly at first, profit-taking, analysts called it, institutions booking gains after a historic run, nothing to worry about, but beneath the surface something else was happening, something mechanical, something unstoppable. The futures market operates on margin. When you buy a silver contract, you don't pay the full value upfront. You post a fraction, typically 10 to 15% as collateral. This allows massive leverage. But it also creates a ticking bomb. If silver's price drops 5% and your leverage 10 to 1, you've lost 50% of your margin. The exchange notices. They issue a margin call. You have hours, sometimes minutes, to deposit more cash. If you can't, they liquidate your position. They sell your contracts at market price, regardless of whether it's favorable. They do this to protect themselves, not you. And when thousands of leveraged traders hit their margin threshold simultaneously, the exchange doesn't ask questions, it executes. At 1:30 Friday afternoon, silver broke below $100. This wasn't just a psychological level, it was a technical trigger. Massive option positions set to expire that very day sat at the $100 strike. Dealers who sold those options had hedged by buying silver futures. As the price fell through 100, those hedges became unnecessary. The dealers sold, not gradually, not carefully. They dumped futures contracts in size, flooding the market with supply. This created a cascade. The dealer selling pushed prices to 98. At 98, another wave of margin calls triggered. More forced liquidation, more selling, 95, 90, 85. Each level broken unleashed a new wave. Stop-loss orders placed by traders who thought they were protecting themselves became execution orders. Algorithms designed to cut losses didn't hesitate. They sold and sold and sold. By 2:30, silver touched $78.53. In 6 hours, the metal had lost 36% of its value, the fastest intraday collapse in recorded history. Gold, which typically moves in sync with silver but with less volatility, suffered its own carnage. From $5,594, it plunged to $4,941, a 12% drop, the largest single-day decline since the early 1980s. The sell-off wasn't limited to precious metals. Copper, platinum, palladium all crashed. But silver, with its smaller market size and higher leverage, experienced the most brutal destruction. Let's be precise about what this means in human terms. If you held 100 ounces of physical silver Thursday night, worth $12,064, that stack was valued at $7,853 Friday evening. $3,611 vanished. Not stolen, not taxed, simply repriced by market forces you couldn't control. If you held shares in SLV, the silver ETF, you watched 31% of your account evaporate in a single trading session. If you were leveraged in futures, you likely received a margin call around 1 o'clock. If you didn't have cash to meet it, your broker sold your position, probably near the lows, probably at $78. You bought at 110, you were forced out at 78. Loss? 29%. But because you were leveraged 10 to 1, that's not a 29% loss on your position. That's total account liquidation. Your entire balance gone. In India, where silver trading on the MCX exchange mirrors global prices, the devastation was even more dramatic due to currency translation. Silver peaked at 420,000 rupees per kilogram earlier in the week. By Friday close, it traded at 291,000, a loss of 129,000 rupees per kilogram. Retail investors, many of whom entered the market in the past 60 days chasing the rally, saw life savings cut in half. Social media exploded with stories of families who had liquidated fixed deposits, who had borrowed against property, who had gone all in on silver at $110, $115, $120, convinced the rally would continue to $150, $200, $300. They're now underwater, badly, and they're asking the same question everyone asks after a crash: what happened? The surface explanation is simple. Warsh nomination, dollar strength, profit-taking. But surface explanations miss the architecture. The real cause of Friday's massacre wasn't news, it was structure. The precious metals market, particularly silver, has become a leveraged casino. Open interest in silver futures, the total number of outstanding contracts, had reached all-time highs in January. Every contract represents 5,000 ounces. Every contract is traded on margin. The concentration of speculative positions measured by the Commitment of Traders report showed extreme bullish positioning. Everyone was long, everyone was leveraged. Everyone assumed the rally would continue. This created a fragile equilibrium. The market was a pyramid of leverage, balanced on a razor's edge. One strong gust, and the whole structure would topple. Warsh was the gust. But there's another force at work: gamma. Most retail investors have never heard this term, but it controls more price action than supply and demand. Gamma measures how much a dealer's hedge position changes as the underlying asset moves. Here's how it works. An investor buys call options on silver, betting it will rise. The dealer who sells that call option doesn't want to take directional risk, so they hedge by buying silver futures. If silver rises, the futures profit offsets the option loss. If silver falls, the reverse occurs. This works smoothly in normal conditions, but when massive option positions expire on the same day, and the price moves violently through those strike levels, dealers are forced to adjust their hedges rapidly. This creates a feedback loop. As silver falls, dealers sell futures to rebalance. Their selling pushes prices lower. Lower prices force more hedge adjustments, more selling, more decline. It's a mechanical process. No human makes these decisions. Algorithms execute automatically. And on Friday, with enormous option positions expiring at $110, $105, $195, and $90, the gamma unwind became a cascade. Each level broken triggered selling. That selling broke the next level. The machine fed itself until it exhausted the fuel. Liquidity, or rather the lack of it, amplified the disaster. In normal markets, when a seller appears, buyers step in at slightly lower prices. This creates orderly price discovery. But Friday wasn't normal. As silver broke below 100, the buyers disappeared. Market makers, the firms obligated to provide bids and offers, widened their spreads. Instead of quoting 99.5 bid, 100 offer, they quoted 95 bid, 100 offer. The gap meant any seller had to accept a $5 haircut just to exit. This discouraged small sellers but didn't stop large forced liquidations. Margin calls don't care about bid-ask spreads. They demand immediate execution. So the sales hit the market. And with no buyers, prices gapped lower. 98 to 95, 95 to 90, 90 to 85. Each gap represented a zone where no trades occurred. The price simply jumped from one level to another. If you had a stop-loss order at 92, you didn't get filled at 92, you got filled at 87. The slippage added insult to injury. Now, let's address the narrative circulating in financial media. They're calling this a correction. They're saying silver was overbought, overextended, due for a pullback. Technically true. But correction implies normal market function. This wasn't normal. Corrections are orderly, gradual, distributed over time. What happened Friday was a liquidation event, a forced unwinding of speculative positions driven by mechanical imperatives, not human judgment, and the implications extend far beyond silver. JP Morgan's head of commodities, Marko Kolanovic, issued a note to clients late Thursday, hours before the crash. He warned that silver had entered bubble territory, driven by what he called meme traders attempting to corner the market. His price target for year-end? $50. That's a 50% decline from Friday's close, a 70% decline from Thursday's high. His reasoning is straightforward. Silver's industrial demand is real. The structural deficit, where consumption exceeds production, is real. But the recent price action has decoupled from fundamentals. The move from 80 to 120 in 3 weeks wasn't driven by solar panel manufacturers or electronics producers. It was driven by speculators using leverage to chase momentum, and momentum trades end badly. Always, without exception. Kolanovic points to history. In 1980, when the Hun brothers tried to corner the silver market, prices spiked to $50. Then they crashed to 10. The speculators were wiped out. The industrial users waited patiently and bought the dip. In 2011, silver rallied from 20 to 49 on investment demand. Then it crashed back to 26 within months. The pattern repeats because human psychology doesn't change. Greed drives prices beyond rational levels. Fear drives them back below. The cycle is eternal. But there's a counter-argument. HSBC's precious metals analysts published a research note Friday afternoon defending silver's long-term prospects. They acknowledge the near-term volatility but maintain that structural deficits will support prices. According to their data, global silver supply is projected to fall short of demand by 1.2 million ounces in 2026. Solar panel production alone will consume record quantities. Electric vehicle adoption requires silver for conductive components. 5G infrastructure build-out demands the metal for circuitry. These aren't speculative narratives. These are contracts, purchase orders, committed industrial demand. And unlike leveraged traders, industrial users don't sell when prices drop. They buy, because they need the physical metal to manufacture products. HSBC's price target for year-end? $135. They see Friday's drop as a temporary shakeout, a necessary purge of weak hands and excessive leverage. Once the speculative froth clears, they argue, the fundamental supply-demand balance will reassert itself. Prices will recover. The $100 level, now broken, will become support again, and the rally will resume, albeit at a slower, more sustainable pace. So which camp is correct? JP Morgan's bearish $50 target or HSBC's bullish 135 projection? The honest answer is nobody knows. Both narratives are plausible. Both are supported by data. The market will ultimately decide. But here's what we can say with certainty. The decision won't be made by fundamentals, not in the short term. In the short term, price is driven by positioning, by leverage, by flows. And right now, positioning is damaged. Leveraged longs have been liquidated, margin requirements have increased, risk appetite has evaporated. These are mechanical headwinds. They don't care about solar panel demand or industrial deficits. They care about account balances and margin calls. The dollar's role in this collapse cannot be overstated. When Warsh's nomination hit the wires, the dollar index spiked. It rose nearly 2% in hours. This matters because precious metals are priced in dollars globally. When the dollar strengthens, it takes more euros, more yen, more rupees to buy the same ounce of silver. For foreign buyers, the metal becomes more expensive even if the dollar price holds steady. This reduces international demand. And silver is a global market. Chinese manufacturers, Indian jewelers, European industrial users all contribute to demand. When the dollar surges, their purchasing power declines. They step back, and when the marginal buyer disappears, prices fall. Warsh's hawkish reputation suggests the dollar will remain strong. If he raises interest rates to combat inflation, if he tightens monetary conditions, if he prioritizes currency stability over asset prices, the dollar will appreciate. And that appreciation creates a persistent headwind for precious metals. This is the fundamental shift that many silver bulls haven't internalized. The environment that supported the rally, weak dollar, negative real rates, dovish Fed, is reversing. The new environment, strong dollar, positive real rates, hawkish Fed, is hostile to non-yielding assets. This doesn't mean silver goes to zero. It means the tailwinds have become headwinds. There's another element to consider, the concentration of positions in exchange-traded funds. SLV, the largest silver ETF, holds over 600 million ounces of physical metal in vaults. When investors buy shares, the fund purchases silver to back those shares. When investors sell, the fund must sell silver to redeem the shares. On Friday, SLV saw massive outflows. Retail investors watching their accounts implode hit the sell button. The fund, bound by its structure, had to dump physical silver into an already collapsing market. This added supply pressure exactly when the market couldn't absorb it. The ETF mechanism, designed to provide liquidity and convenience, became a transmission mechanism for panic. Now let's talk about Monday. The market opens in less than 48 hours. What happens next will determine whether Friday was capitulation or just the beginning. If silver gaps higher at the open, if bargain hunters step in around $80, if physical buyers emerge to scoop up metal at 40% discounts, then the bottom may be in. We could see a relief rally back to 90, 95, potentially 100. This would fit the classic pattern. Panic selling exhausts itself, smart money buys the dip, prices stabilize, the market enters a consolidation phase. But there's an alternative scenario. If silver gaps lower Monday, if selling resumes, if technical support at $75 fails, the next stop is 60, then 50, then who knows? Because once a market enters freefall, once confidence evaporates, once the narrative shifts from can't lose to can't win, there's no floor. The price falls until it finds buyers. And in a deleveraging, those buyers may demand extreme discounts. The warning signs are already visible. Open interest in silver futures dropped Friday but remains elevated. This means many positions are still underwater. Many traders are still hoping for a rebound to exit at break-even. If that rebound doesn't materialize, they'll eventually capitulate. Forced selling will resume. Margin clerks don't care about your break-even level, they care about risk. And if you can't meet margin, you're out. That forced selling creates the next leg down. Technical analysts are watching key levels. $80 represents Thursday's intraday low. If that breaks, the next support sits at 70 to 75, a zone established by late 2025 highs and the 50-day exponential moving average. Below that, the abyss. No technical support exists until you reach the $60 region. A decline to 60 would represent a 50% crash from peak. Unprecedented, but not impossible, because Friday proved that anything is possible when leverage unwinds. For the retail investor watching this unfold, the question is existential. Do I sell now and take the loss? Do I hold and hope for recovery? Do I buy more at lower prices and average down? There's no universal answer. It depends on your time horizon, your risk tolerance, your conviction in the underlying thesis. But here's what you need to understand. If you're leveraged, if you're trading futures, if you're using margin, your decision may not be yours to make. The broker will make it for you. And they'll make it at the worst possible moment, at the worst possible price, in the worst possible way, because that's how the system works. It's designed to protect the institution, not the individual. If you hold physical silver, coins, or bars in your possession, you have time. You're not subject to margin calls. You can wait. You can hold through the volatility. You can even buy more if you believe the long-term thesis remains intact. But you have to be honest with yourself. Are you holding because you understand the fundamentals? Or are you holding because you can't accept the loss? Because ego and analysis are different things. Ego says, I can't be wrong. Analysis says the data changed and I need to adjust. The market doesn't care about your ego. The broader lesson here extends beyond silver. It applies to every asset, every market, every investment. Leverage is a weapon. In rising markets, it amplifies gains. In falling markets, it guarantees destruction. The same tool that can double your money in weeks can erase your account in hours. And the institutions that provide leverage, the brokers, the exchanges, the clearinghouses, they all know this. They profit whether you win or lose. Because they collect fees on every trade, they earn interest on margin loans, they benefit from volatility. Your gain or loss is irrelevant to their business model. Understanding this reality is the first step toward survival. Friday's silver massacre will be studied for years. It will appear in textbooks as a case study in market mechanics, leverage risk, gamma squeezes, and liquidity crises. Analysts will dissect the timeline, the triggers, the cascades. But for the people who lost money, it's not academic, it's personal. And the hardest truth is this: it's not over. The deleveraging that began Friday will continue until it's complete. Until every over-leveraged position has been liquidated. Until every margin call has been met or defaulted. Until every weak hand has been shaken out. Only then will the market stabilize. Only then will price discovery return to fundamentals. Only then will the opportunity for legitimate investors emerge. The question that actually matters is not where was the top or where is the bottom. The question is, do you understand how the game is played? Because Friday revealed the machinery. It showed you that markets aren't about fundamentals in the short term. They're about flows, positioning, leverage, and forced liquidation. The institutions know this, the professionals know this, and now you know this. What you do with that knowledge determines everything. Do you continue playing a game where the rules favor the house? Or do you step back, reassess, and position yourself for the long term with strategies that can't be liquidated on someone else's timeline? Silver will trade again on Monday, the price will move, some will make money, most will lose more, and the cycle will continue until the leverage is purged and the fundamentals reassert themselves. Whenever that happens, if it happens, will depend on forces larger than any single market. It will depend on the dollar, on interest rates, on monetary policy, on global trade, on geopolitical stability, all variables outside your control, which brings us back to the only variable you can control: your positioning, your leverage, your risk, your decisions. 6 hours destroyed billions. The next 6 hours could destroy billions more. Or they could begin the recovery. The market doesn't tell you in advance. It just acts. And those who understand the machinery survive. Those who don't become liquidity for those who do. That's the flow of money. And on Friday, it flowed away from 36% of silver holders in 6 brutal hours. The only question is whether you were one of them or whether you saw it coming.